It is Wednesday, January 28th, 2026. And if you are listening to this, there is a really high probability that you're sitting inside a structure somewhere along the Front Range, maybe up in the mountains,
Right.
that is currently valued between, what, $750,000 and $2.5 million.
Which, on paper, looks incredible. I mean, you check your net worth statement, the bar graph is tall, you are, by every technical definition, wealthy, you're equity rich.
But here's the tension, and it's the specific reason we're doing this deep dive today.
Yeah.
You might feel equity rich, but when you go to the grocery store or you pay your insurance premium...
Or you just look at the liquid cash in your checking account.
Exactly. You feel broke. Or at the very least, you feel squeezed.
That's the paradox of the 2026 Colorado homeowner. You're sitting on this massive pile of wealth, likely the biggest asset you'll ever own, but it's trapped.
It's stuck.
It's stuck in the drywall, the foundation, the landscaping. And unlike a few years ago, you can't just stick a sign in the yard on a Friday and have a bidding war by Sunday to cash out.
Oh, those days are firmly in the rearview mirror. So we've got this illiquid mountain of money and a cost of living that just keeps grinding up. The mission for today is to figure out how to bridge that gap. We've got a stack of sources here. The 2026 outlet from the Leeds School of Business, data from the Colorado Association of Realtors, analysis from Reliance Financial, and some really critical legal updates on home equity regulations.
And the goal isn't just a market update. We want to fundamentally shift how you view that mortgage payment. We need to stop looking at it as a debt you have to service and start looking at your home as a capital lever.
I like the sound of that. But before we pull that lever, we need to understand the machine we're operating. What's the actual weather report for the Colorado economy right now in early 2026? Because I keep hearing mixed signals. Is it good? Is it stalling?
Mixed is probably the polite way to put it. If you look at the macro data from the Leeds School of Business at CU Boulder, the headline number is GDP growth. They're projecting about 2.1% growth for Colorado this year.
Which is fine.
It's fine. It's positive. It means we're not in a recession. But it's definitely not a boom cycle. We're not seeing that explosive growth. It's more of a grind higher scenario.
Okay.
But here's the friction point, and this is what hits you, the homeowner, directly. Inflation is sticky.
We've been talking about inflation for years now. I thought the narrative was that we beat it.
Nationally, maybe, but specifically in the Denver-Aurora-Lakewood area, the projections show inflation hanging around 3.5% for 2026. That is persistently higher than the national average.
So wait, think about that dynamic.
Yeah.
Your asset value, your home price,
Yeah.
has basically flattened out.
Yeah.
But the cost of your life, your groceries, your services, is rising faster here than almost anywhere else.
And that's despite the job market holding up.
That's what I was going to ask.
The job market is deceptive.
Right.
We're forecasted to add about 17,500 new jobs in Colorado this year. But there's a lot of churn. People are moving jobs, industries are shifting. It isn't that comfortable, safe feeling we had a decade ago. And when you look specifically at housing, the leverage has completely flipped from where we were in the early 2020s.
This was the data from the Colorado Association of Realtors, right? This buyer-favorable shift.
That's the term they use. And the numbers they're stark. In Denver, active listings ramped up over 21% heading into this year. That's a lot of inventory just sitting on the market.
So houses are just sitting there.
They are sitting. If you go down to Colorado Springs, inventory hit levels we haven't seen since 2014.
Wow, 2014.
Yeah, that's a massive supply glut compared to what we're used to. And in some pockets, you look at Aurora, centennial prices have actually softened. We're seeing drops of 5% to 8%.
That's a harsh reality check. For a long time, the strategy was sleep in your house and make $50,000 a year in appreciation.
That strategy is on pause. The easy equity gains are gone. But the cost of holding that property, that's the real story.
I filled this one personally when my insurance renewal came in.
You and everyone else. Colorado was already ranked the 5th most expensive state for homeowners insurance back in 2024.
I remember that.
Fast forward to 2026. With the climate risks, the hailstorms, premiums have just kept climbing. It's the silent killer of cash flow.
And I imagine it's even worse if you're in a condo or a townhome with an HOA.
It's a nightmare scenario for some of these attached communities. We've seen reports of HOA fees jumping 200%.
Yeah.
Even 500%.
500%. That's effectively a second mortgage payment.
It is. And it's because the master insurance policies for these large complexes have just exploded in cost. So let's connect the dots here for the listener.
Okay.
You have an asset that's stabilizing or slightly dropping in value. You have inflation eating your grocery budget.
Yep.
And the cost to simply keep the house insurance and taxes is going up.
Which creates this massive urgency. You can't just let that equity sit there and be dead while it's costing you more and more to keep it. You have to make it work.
Right.
And here's the big hurdle. Most people are terrified to touch their equity.
And rightfully so. This is the golden handcuff dilemma.
Because of the interest rates.
Exactly. If you bought or refinanced in 2020 or 2021, you're likely sitting on a 2.5% to 3.5% interest rate. That is an asset in itself. It is cheap money. If you have a $300,000 balance at 3%, that loan is gold.
So the conventional wisdom is just don't touch it, don't ever touch it.
Correct. And usually when people need cash, they think of a cash out refinance. They refinance the whole mortgage, take out some extra cash, and get a new rate. But in 2026, that is a mathematical disaster.
Walk us through why. Because rates have come down a bit, right? We're seeing 30-year fixed rates in the low 6% range.
That doesn't sound too terrible, historically.
Historically, no. But mathematically, for you, it's bad. Let's look at the Reliance financial analysis. Say you have that $300,000 balance at 3%. If you do a cash-out refi to get $50,000 for a renovation or to buy a business,
Okay.
you have to refinance the entire $350,000 at the new rate. Let's call it 6.5%.
So I'm effectively doubling the interest rate on the money I already owed. Exactly. You're paying 6.5% on the old money just to get access to the new money. You're destroying the value of that low-rate loan instantly. It's incredibly inefficient.
So the cash-out refi is dead.
For anyone with a sub 4% rate, yes. Take it off the table.
Okay, so if I'm squeezed and I need liquidity but I can't refinance, what is the play? The sources keep mentioning the HELOC as the utility knife for 2026.
The home equity line of credit, it's the only logical tool right now. The beauty of the HELOC is that it sits in the second line position.
Meaning it doesn't disturb my primary mortgage.
It leaves your 3% rate completely alone. You are layering a secondary capital facility on top of your primary loan. You're quarantining the new debt.
Okay, but I've always been a bit wary of HELOCs because of the variable rate. And also, isn't it just another monthly payment I have to worry about?
It is, but the structure is very specific, and that's what we need to highlight. A standard HELOC has a 10-year interest-only draw period.
That's crucial.
This is crucial for cash flow. When you open a HELOC for, say, $100,000, you don't get handed a sack of cash. You get a credit limit.
Like a credit card.
Similar concept. You pay zero interest if you have a zero balance. It costs you nothing to have it sitting there as a safety net. But when you do draw on it, let's say you take out $50,000 to invest in a business, during that first 10 years, your mandatory payment is interest only.
So I'm not forced to pay back the principal immediately.
No. Which keeps the monthly carrying cost much, much lower than a fully amortized loan where you're paying down principal and interest from day one. It gives you breathing room.
What about the rate risk, though? You mentioned variable. If inflation is sticky, could rates spike and blow up my payment?
That is the valid concern. HELOC rates usually track the prime rate. However, look at the Leeds School forecast. The Federal Reserve is expected to cut rates by another 75 basis points through the end of 2026.
So the trend is actually my friend here.
For once, yes. We are not in the hiking cycle of 2023. The wind is at your back. Variable rates should be trending down or staying flat, not spiking.
Let's talk about the math of this versus the refinance. The sources call this blended rate math. I want to make sure I understand this because this seems to be the key metric.
This is the number every listener needs to calculate on the back of a napkin right now. Let's go back to our example. You have $300,000 at 3.5%. You need $50,000. If you take that $50,000 as a HELOC at, say, 8.5%, which is a realistic rate for 2026, it sounds high, right?
8.5% sounds painful compared to my 3.5% mortgage.
It does, but you have to look at the weighted average of the total debt. You have a huge chunk of money at 3.5% and a small chunk at 8.5%. When you blend those, your effective interest rate on the total $350,000 debt is probably around 4.2%.
Which is way, way lower than refinancing the whole thing at 6.5%.
Huge difference. You're saving thousands of dollars a year in interest by accepting a higher rate on a smaller amount of money.
Okay, that clicks. So we keep the primary, we layer on the HELOC, now we have access to capital. The big question is capital deployment. What do we actually do with the money?
Right.
Because taking on debt just to buy a boat or go on a vacation in this economy seems ill-advised.
Please do not do that. That is how you lose the house.
So what are the smart plays?
Option one is the arbitrage and debt consolidation play. This is the most immediate fix for that cash flow squeezed feeling we talked about. We know consumer credit delinquencies are rising in Colorado. A lot of people, even high earners, are carrying credit card debt.
It's so easy to do. You put a vacation on the card, then a car repair, and suddenly you're carrying a balance at 22%.
22% is wealth destruction. It's an emergency. If you have $30,000 sitting on cards at 22%, and you can move that to a HELOC at 8.5% or 9%, you are instantly stopping the bleeding.
And there's a tax angle, too, isn't there?
Sometimes. If the HELOC funds are used for home improvements, the interest is often tax deductible. Credit card interest is never deductible. But even without the tax benefit, just the spread between 22 and 9% is massive arbitrage. You're putting money back in your pocket every single month.
That makes perfect sense. Clean up the bad debt. But what if I want to play offense?
Oh.
I was reading the source from CEO Home Equity about the speed of business. This seemed geared toward entrepreneurs.
This is fascinating. In the old days, like 5 years ago, getting a home equity loan was a slog. It took 45 to 60 days. Banks needed manual appraisals. Underwriting took forever. It was just too slow for business.
And now?
Now, in 2026, we have fintech solutions and automated valuation models, AVMs, that are specific to the Colorado market. They can see your equity instantly.
They claim they can fund in as little as 5 days.
Which is a game changer. Let's say you're looking to acquire a small business. That's a very popular wealth strategy right now, buying boring, cash-flowing businesses. If you find a deal, you can't tell the seller, hang on, let me wait 2 months for Wells Fargo to approve my loan. You need to be cash ready.
So the HELOC effectively turns your home equity into a business line of credit.
Precisely. And unlike a traditional business loan, which might have a strict 5-year repayment term and high monthly payments, the HELOC gives you that interest-only flexibility. It lets you manage your cash flow while you ramp up the new business.
That is a powerful tool for the self-employed. But let's pivot to the homeowner who just wants to improve the house. We said earlier that appreciation is flat. The market isn't doing the work for us anymore. So how do we manufacture appreciation?
This is where you have to be disciplined. You cannot just do the renovation you want. You have to do the renovation the market wants. Usage Realty put out a great analysis based on the cost versus value report for the mountain region.
I looked at that list, and I have to admit I laughed. Because the #1 ROI project for 2026 is not a kitchen. It's not a bathroom.
No, it is not sexy. The #1 return on investment, garage door replacement.
The garage door.
You recoup about 236% of the cost.
Wait, 236%. So if I spend $4,000 on a door, I add nearly $10,000 in value. How is that possible?
It's all about the first impression. Curb appeal. In a market where inventory is high, remember, listings are up 21%. Buyers are looking for reasons to say no. A beat-up garage door signals deferred maintenance. A brand new high-end door signals quality.
That's defensive.
It's defensive asset protection. The other top winners were similar: steel entry door replacement and manufactured stone veneer. These are returning 180 to 200% of the cost.
It's basically the skin of the house.
It is. Contrast that with a minor kitchen remodel, that's getting about 110% return, which is still good. You get your money back plus a little profit. But it's not the 200% home run that the exterior updates are.
So if I'm pulling equity to renovate, I shouldn't just be picking out marble countertops. I should be looking at what makes the house stand out from the curb.
If you need to sell in 2026 or 2027, you do not want to be the house sitting on the market for 90 days. These renovations are about liquidity, making sure the asset remains saleable in a buyer's market.
I want to shift gears to the risk side, because we are talking about leveraging your home, your sanctuary. And there was a headline in the Colorado Sun that really caught my eye. It used the phrase home equity theft.
This is a silent risk, and frankly, it's terrifying. Most people don't know this mechanism even exists.
What is it? It sounds illegal.
Well, until very recently, it was fully legal. Here's the scenario. You fall behind on your property taxes. Maybe you lose your job or have a medical issue, and you owe the county, say, $5,000. The county forecloses on your home to pay the debt. They sell your house for $500,000. Now, logic would say they take their $5,000 and give you back the $495,000 surplus. That's your equity.
Right. That's my money.
But in many jurisdictions, including parts of Colorado, the government was keeping the entire surplus.
They kept the $500,000 because of a $5,000 debt.
That is the theft. They would wipe out your entire net worth over a small tax bill. Now, the good news is the U.S. Supreme Court ruled this unconstitutional recently. They said, you can take what is owed, but no more.
Thank goodness.
However, the reason we bring it up is that the Colorado legislature is still in the process of cleaning up the state laws to align with that ruling. It's a messy process,
Right.
and it just highlights how vulnerable your equity can be if you're not paying attention.
So the lesson here isn't just about laws, it's about liquidity.
Exactly. If you run into a cash crunch and can't pay your taxes, having an HELOC available, even if you haven't drawn on it, is a safety net. You can draw on the equity to pay the taxes and save the house. It's better to have debt than to lose the asset entirely.
That brings us to the leverage warning. We are wealth strategists today, but we need to be responsible. How much is too much leverage?
The standard safety net is 20%. Most lenders, and certainly any prudent advisor, will suggest you keep at least 20% equity in the home. Do not tap it up to 100%.
Because if the market softens further.
Right. If prices drop another 5% in Denver, which is possible, you do not want to be underwater. You need that buffer. And you need a plan for the payments. We mentioned the Fed is cutting rates, but if global events cause inflation to roar back, say, to 5 or 6%, the Fed might have to reverse course and hike rates.
And then my variable HELOC payment jumps.
Correct. So you need to have a plan. The HELOC is a bridge, not a permanent destination. You should have a clear path to paying down that principal over time, not just servicing the interest forever.
So let's bring this all together. We've covered the macro, the high inventory, the sticky inflation. We've covered the strategy, the HELOC, as a way to unlock debt equity without losing the low primary rate. And we've looked at deployment debt consolidation, business buying, and smart renovations.
If you're listening to this, you're in a very unique position. You're holding a valuable asset in a stabilizing, slightly inflationary economy. The Colorado home equity play isn't about getting rich quick. It's about efficiency.
It's about waking up that dead capital.
It's asking yourself, is my equity working for me, or is it just a number on a Zillow page? If you can use a HELOC to arbitrage high-interest debt or fund a business acquisition with that 5-day speed, you're winning.
And you're doing it all while keeping that 3% primary mortgage. That seems to be the golden rule here.
That is the cornerstone. Do not sacrifice the primary rate.
So for the listener, here's your homework. Sit down and calculate your blended rate. Look at your debts, look at your mortgage, and see if layering a HELOC actually lowers your overall cost of capital.
And ask yourself if your cash flow squeezed unnecessarily.
I want to leave everyone with one final thought. We talked a lot about the golden handcuffs.
Yes, the lock-in effect. I want you to consider this. Is holding on to that 3% mortgage actually preventing you from making a life-changing financial move?
What do you mean?
Sometimes we get so obsessed with saving the low rate that we miss an opportunity. Maybe there's a business you could buy that returns 25% a year. Maybe there is an investment that changes your family's trajectory. If you're too scared to touch your equity because you want to save 3 percentage points of interest, you might be stepping over dollars to pick up pennies.
That's a powerful perspective. Sometimes the cost of not accessing your capital is higher than the interest rate you're trying to save.
Don't let the 3% rate become a prison. Let it be a foundation.
That is the deep dive for today. Go check your garage doors, check your equity, and we will catch you next time.